Accounting equation and Excel. Adjusting entry related to accounts receivable. Get ready and some coffee because we're about to learn the accounting foundation, the accounting equation using Excel. First, a word from our sponsor. Yeah, actually, we're sponsoring ourselves on this one because apparently the merchandisers, they don't want to be seen with us. But that's okay, whatever. Because our merchandise is better than their stupid stuff anyways. Like our crunching numbers is my cardio product line. Now, I'm not saying that subscribing to this channel, crunching numbers with us, will make you thin, fit, and healthy or anything. However, it does seem like it worked for her. Just saying. So, subscribe, hit the bell thing, and buy some merchandise so you can make the world a better place by sharing your accounting instruction exercise routine. If you would like a commercial-free experience, consider subscribing to our website at accountinginstruction.com or accountinginstruction.thinkific.com. We are in Excel. If you don't have access to this workbook, that's okay because we basically built this from a blank worksheet but started in a prior presentation. So if you want to build this entire worksheet from a blank sheet, you could begin back there or just construct your own worksheet as we go, or possibly just follow along with good old paper and pencil. If you do have access to this workbook, though, 5 tabs down below. Example, in essence, answer key. Month 1, first month of operations. Month 2, second month of operations. Practice tab having pre-formatted cells so you can practice the practice problem with less Excel formatting. The ADJ tab, the one we will be working in, is where we started with a blank worksheet, but are basically working within a template now. However, we will be adding to that template as needed as we go, practicing our Excel tools and formatting as we do so. Let's go to the example tab to get an idea of what we will be doing, remembering that we're basically building our bookkeeping system using the accounting equation as, in essence, our trial balance, from which we can construct our major financial statement reports, balance sheet, income statement, statement of equity. Thus far, we've done 1 month of operations, closed it out, second month of operations, and then now we're looking at our adjusting process. It's easiest to think of the adjusting process as basically a separate entity, a CPA firm, public accounting, or tax preparer doing it, although you could be on both sides of the table doing both processes. Similar concepts, same concepts will be in play, where we're going to take the information from the bookkeeping system, possibly from QuickBooks or Xero. We're going to put that information into our Excel worksheet as of the cutoff point, the point that we want to make the financial statements as of. And then we're going to do our adjusting entries to get the financial statements as close to whatever basis that we're using as possible, often an accrual basis, but possibly you're doing the same thing for tax basis, for example. And so once we get the adjusting entries into our Excel worksheet, we might then enter them back into the QuickBooks system or the Xero system is the general idea. We're now looking at an adjusting entry related to accounts receivable. It's a classic adjusting entry in that most adjusting entries do not deal with cash, and there's usually a timing situation, meaning there's going to be at least one balance sheet account, one income statement account. This adjusting entry follows that conceptual framework. Now, you're only going to really see this kind of adjusting entry in particular industries, oftentimes possibly in like a job cost type of system, because if you're on an accrual basis, that's when you're going to have this accounts receivable going on. If you're in a job cost system, which might be easiest to visualize in like a CPA firm or a law firm, where the partners are using the staff in order to do work, telling the partners about the work so that the partners can then bill the clients based on the work done by the staff. You can see if that's the case, there's kind of a timing issue involved here where the staff's going to do work, but then the partners aren't going to bill for that work until they bill for it, which might be on like a weekly basis, a bi-weekly basis, a semi-monthly basis, or a monthly basis, for example. And that means that we have accounts receivable, which is an accrual account because it represents work that has been done for which cash has not been received. Therefore, there's a timing difference between when the cash is received and when the work is done. However, when we record the accounts receivable, it's still not the point in time that the work was actually done, right? So we still have this kind of timing issue. Now, from a QuickBooks standpoint, what is QuickBooks going to do? If it's trying to be on an accrual basis, it has to record something with a form. There's got to be something that triggers the transaction. And clearly the invoice is going to be the form closest to the point in time the work was actually done, rather than when the cash was received, which is of course going to be way after the work was actually done. But it's still not perfect, right? That's just the best we can do with the system that has been set up, because in actuality, the work might have been done in February, but the invoice wasn't sent out until March due to the fact that they had to get the timesheets and whatnot in order to create the invoice. And that's where the problem comes into play. Now, if you're actually selling inventory, it's probably not going to happen as much, because normally you're going to get the order before you fulfill it and send the inventory. But if you have inventory in a job cost kind of system, you might have a similar kind of problem if you're in construction or something like that. So I want to add the component of inventory because it makes the transaction a little bit more complex and forces us in the adjusting entry process to think about how we're going to deal with the subledgers of inventory and accounts receivable as we do basically this adjusting entry. So we're going to keep that concept in play, remembering that the idea here is that the invoice has already been recorded. It's not incorrect if you think about the full time frame. It's just in essence been recorded in the wrong period. It got reported in March, and it should be recorded before the cutoff date, where we have the 2 months ended January and February. So it should be recorded before February. So the revenue should be in this period rather than the following period. Now, you might think this is a minor detail, and sometimes it might be depending on the circumstances, but you can imagine the reason we have an accrual period is in part to stop companies from manipulating their books using a cash-based type system, for example, where they can just use the timing differences, right? So in other words, if they want to look better or worse, they can adjust when revenue and expenses are going to be reported so that the total revenues come out the same, but they're going to be adjusting it across the cutoff date. So it becomes significant. If you get into auditing, then you're going to have a similar kind of situation where you have to test the cutoffs and make sure that they're reporting the proper revenue in the proper period. So that's going to be the general idea. So basically, we want to pull the invoice into before the cutoff date. Now, note that if you're using QuickBooks, you might be tempted to say, well, the easiest way to do that is just to change the date of the invoice in QuickBooks, and then you're done. But we don't really want to do that, because we don't want to mess up the system that is in place on the bookkeeping side. I don't want to go into the bookkeeping's books and say, well, you usually bill once a month, but for this particular bill, I'm going to imagine you made that bill at the end of the month because I need to pull it into the current time period. That would mess up the normal process. If they looked at their books, they'd say, why did I bill at this weird stage? And that'll harm the communication with the clients and possibly the payroll situation and that kind of thing. So what we want to do instead is enter an adjusting entry before the time period, which basically mirrors the invoice. We're not going to enter an invoice form, because if I entered an invoice form, it's going to be difficult to identify that this was an adjusting entry versus a normal invoice. When I enter it into QuickBooks, then I would enter it as a journal entry, an adjusting entry that would mirror the transaction of the invoice. Next thing you might ask is, well, isn't that going to mess things up? Because you already entered the invoice, it just was entered in March instead of February. That'll make it correct in February, but then once March comes around, you'll have the invoice entered 2 times, and that's correct. It'll be wrong, so it'll be entered 2 times, which is something that oftentimes the CPA firms don't fully consider, because they're just trying to do their job of making things correct as of the cutoff date, and they don't think about the idea that you're messing up the books once March rolls around, right? So to properly think about that, it was like, well, how can I do that? Well, I'm going to enter it in there as of the cutoff date, and then I'm going to reverse it as of the first day after the cutoff date so that I get the financial statements reported correctly on an accrual basis as of the cutoff date, and then I remove it so that the invoice, the original invoice, remains on the books just as it is, as it works for the normal bookkeeping process. All right, so that's going to be the general idea. Remember, this is not something that maybe you would do all the time for small businesses that are on a tax basis if your basis of accounting is consistent, but it might come up with specific types of industries. And if you're in an auditing situation for larger businesses, it's certainly something that you would be looking for with regards to the cutoffs to make sure that revenue has been properly recorded in the proper period. All right, let's go to the adjusting tab. And we're going to imagine that we looked at the sales that were done. We're going to say, okay, we know this is a job cost kind of system if it were a job cost system. And we saw that the sales that happened right after the cutoff date in March, we went through and checked those and said, when was the actual revenue earned for those items? And we found this one particular invoice we're going to imagine where the work was done before the cutoff date, and therefore we need to do an adjusting entry to pull it in to revenue being recognized before the cutoff date. We'll talk about the reversing entry in a future section. So 228, we're going to say this is going to be an ADJ for invoice entered, we're going to say on 3/5, but work was done in February. So we're going to pull it back into the current period. So we're going to imagine the client was Anderson Guitars, and we're going to imagine that we sold them an ELP, one ELP. Now remember, if I just sold them a guitar, it's not as likely that we're going to have this cutoff situation because that would be normally just a sale information. But if it was a job cost situation or a construction, then again, you might be more likely to have the situation. But I want to use the inventory because again, it's going to force us to think about the subledgers and give us a more complex type of transaction. So what I want to do now is enter the journal entry into the system. All right, so what I'm going to do now, remember, if I was doing this in QuickBooks, I would not enter an invoice. I'd just do a journal entry mirroring the invoice, which could cause us problems when we run into the subledgers, as we will see when I go through this. So I'm going to say the ELP, let's say we sell those for, what was it, 500? We sell them for. So I'm going to say the ELP is going to be equal to 500. And then we had to collect the sales tax, which was 0.05. So I'm going to say times 1.05. We're going to have to collect 105%, which is the 500 plus the 5%. That comes out to 525. The other side of that is going to be on the revenue, on the sales side. It's going to increase, but only by the 500. And then the difference is going to be in the sales tax payable. So we're just entering a transaction just like we would enter an invoice. But if it was in QuickBooks, we would enter the actual transaction like this instead of an invoice form. So there's that times the 5%. All right, so that entered that. Now, as I do this, when I enter this into QuickBooks, however, like when I do this in my Excel worksheet, it's going to be no problem because I don't have to deal with the subledgers. But when I enter this into QuickBooks, it's going to say, hey, look, there's a subledger for accounts receivable. We're not going to let you post just a journal entry here because you'll mess up the subledger. If there's no customer for me to tie it to, the subledger will no longer tie out to the accounts receivable. Now, that's usually a good internal control in software like a QuickBooks or Xero. But with these adjusting entries, it's actually a problem because I don't want to hit a customer with it in the QuickBooks system because I just want to make an adjusting entry to make the financial statements correct as of the cutoff and then reverse it. I don't want it to show up in all the detail of the subledger. But QuickBooks is going to force us to do that if I want to enter it into the QuickBooks system. So we have these two issues. If I'm a CPA firm, one is to get it correct for external reporting purposes. And then if I'm going to enter it into QuickBooks, then the question is, how am I going to deal with this subledger issue? We're going to have a similar issue for inventory, which I'll talk about in a second. But first, let's record this half. So I'm going to put the zeros across the board. Going to put the zeros across the board. Oh, not there. Dang it. Control Z. It's okay. There's no need to start swearing. You can just Control Z and undo it. You get all excited. All right. So now, here's my subledger. Now, if I was doing this in like my Excel worksheet to do my adjusting entries, I wouldn't really have a subledger. I would just put in my notes that this was related to this particular invoice where I can see the customer related to it. But when I put it back into QuickBooks, there's going to be a subledger I have to deal with. Now, I could put this under Anderson Guitars in the subledger so that QuickBooks will allow me to post it. But if I do that, then when the client goes into Anderson Guitars, I'm going to have to put this in, and then I'm going to have to reverse it with the reversing entry, and the detail in Anderson's subledger will be all ugly. It'll be all messy because now there's going to be these two transactions that don't really match out, and they're in the format of a journal entry when they should be in the format of an invoice and then a received payment form, and that's kind of ugly. So you could put those two in there and then match it out. And it's not too big of a deal as long as you match it out properly. So it's not, those two things aren't hanging there all the time, but it's still kind of ugly. Your other option is to say, I could create another account called accounts receivable, but don't make it an accounts receivable type account so that QuickBooks doesn't see it needing a subledger. And then you can post to it without touching the subledger at all. That's good, but then it's kind of ugly because then now you have this other accounts receivable 2 account in there, which is kind of ugly. Or we can make another customer. That's what I'll choose to do here. So maybe I make another customer, and this will be where I just dump the information for this clients, for the adjusting client. So I might call it like ZZZADJ client. And the reason I do that is because if it's in alphabetical order, it'll be at the bottom. So hopefully it's kind of out of the way so it doesn't mess up what the bookkeeper is looking at. And then I'm just gonna say we're gonna increase that client by the 500. Now this isn't the actual client, it was Anderson, but I'm just putting it here so that QuickBooks will allow me to record it, right? And then I'll copy down the balance, which is gonna be equal to this plus the sum of these, que paso, and then I'll copy that down. So now my subledger, once I record that, is 22,676, which should tie out to my subledger once I add these two up, which is going to be 22,701. What? Oh, I didn't do the sales tax. Let me do that again. This is going to equal the increase to the 525. That's good. Okay, it's 22,701, and that'll tie out to this. Which is going to be the 22,701. Okay. So then we've got then the inventory. So I'm going to say, all right, the inventory is going to go down by the amount that I'm not going to see on the invoice. The invoice is probably what I'm looking at. But I'm going to have to then go in and figure out what the cost of the things, which would be in the items. For us, I can go to the subledger over here and say the cost of an ELP, I believe it's 400, right? So it's 400, that's what we buy them for. So it's 400, and then the other side's in cost of goods sold. I'm gonna put this equals the 400. So the net income went up by 500, down by 400, so 100 difference on the net income. Now I have this same problem with the inventory because it also has a subledger. However, when I enter this into QuickBooks or Xero, they usually don't have that same internal control forcing me to enter an inventory item in order to allow me to record the transaction, which is actually good. That means that the subledger will not tie out to what's in the general ledger after I record the adjusting entry, but that's okay because I'm going to reverse it. And once I reverse it, they will tie out again. And that allows me to do the adjusting entry and the reversal without messing up the subledger with transactions that are adjusting entries. So we'll see that in a second. I'll go ahead and put an underline here. Let's put an underline, home tab, font group, underline, and then we'll bring down the balance, baby. Let's pull the balance down thus far to see if that transaction is in balance. It is, green 0. So that looks good. So let's sum it up. Equals to SUM, prior transaction plus current activity. Copy, Control C, holding down Shift, right arrow. And then we're gonna right click and paste it, formulas only. Ba-bam. Okay, so there we have it. So now let me check my subledger just to show you what I mean with this subledger. So if I go all the way to my subledger, here's my check number. Now I've changed it, so I'm going to change the check number. It's now being compared to my new activity, which is this inventory right there, 4346. And of course that means it doesn't tie out. It doesn't tie out. Why shouldn't I record the transaction here in the subledger so it does tie out? So I can record. I could, but I don't really want to, because again, I'm just doing the adjustment to get the financial statements correct for external reporting purposes. If I need a subledger in my financial statements, I'll have to add it there to make sure it ties out. But I don't necessarily want to do it in QuickBooks, because in QuickBooks, I'm going to enter it with a journal entry, not an invoice form, and then I'm going to reverse it. So if I put it in the subledger, there's going to be like a transaction here and then a reversal, and the transaction that I put in here will not be the typical format because it's not going to be used in the proper form of an invoice, but rather a journal entry, which is going to make it difficult to tie it all to all the forms together. So I would rather not do that and just say I'm just doing the adjusting entry, and then once I reverse it, that 400 will go back to normal, and therefore the bookkeeper won't have this messy stuff going on in the subledger. And that's going to be the idea. So that's when you're in public accounting, just the more you can kind of think about that, like what can you do to achieve your goal? And then also, how can you make sure that you're not messing up the accounting department's normal cycle? That's both of those things are important. And a lot of people that work in public accounting, especially if they're in like larger business, they're more specialized. They get tunnel vision. They lose sight of that second goal. They start to think like they're fixing the errors of the accounting department, and their job is all they kind of are focusing on to get the financial statements correct, and they lose track of what the real goal is. You're not correcting the errors of the bookkeeping department. You're working, or the accounting department, you're working with the accounting department so that they can do their job, which is different than just simply making the financial statements. Just making the financial statements for external reporting is not actually the end goal necessarily, or the only end goal of the accounting department. The accounting department, again, trying to work well with customers, vendors, employees, and automate things so that the accounting is as small of a problem and as efficiently done as possible. And then it's the other department, the public accounting firm's place to then adjust it to make the financial statements as nice as possible without getting in the way, messing up the system that the accounting department is doing, right? So we want to keep those two things kind of in mind. And when we're working in our Excel worksheet to get the financial statements right, we sometimes might forget what's going to happen if you try to put that back into an accounting system that has the subledgers that you have to deal with. So in any case, in a future presentation, we'll get to reverse these transactions. The other thing you want to kind of keep in mind is which transactions are going to be reversed and which will not be, which transactions are permanent versus transactions that are just timing differences. This is just a timing difference. If I don't reverse it, then again, it'll record that transaction twice, which will be by March, and that'll be, again, messing people up. All right, so that's going to be that one.